Perhaps not surprisingly, the way our brain processes information and the types of information that attract our attention can have significant implications for our investment decision making. Hi, I'm Simon Russell. I'm the founder of Behavioural Finance Australia. This is the second in a series of videos that are designed for individual direct share investors, people investing in Australian shares, perhaps making some of their own investment choices, and it's designed to help them understand, take some of the insights from behavioural finance to improve their investment decision making. Now, at the end of the last video, I left you with a question, and that question was, what proportion of all the information that comes in via our various senses, our sight, our hearing, our smell, for example, what proportion of all that information is consciously processed by our brain? Now, before I give you the answer, let me step you through some of the research related to this point. And looking at some of the research done, particularly at the University of Pennsylvania, but elsewhere also, we can see that approximately 10 million bits of information, individual bits of information, are processed by just one of our senses, which is our sight, every second. 10 million bits of information hitting our retinas and being processed by our visual cortex. The other senses contribute, sort of less prolific, but they do contribute another 1 million or so bits of information per second. So in total, about 11 million bits of information are coming through our various senses. But you look at what the research suggests is the amount of information that's being processed consciously, that we're consciously aware of, and it tends to be in the range of about 40 to 50 bits of information per second. So you can see 40 to 50 bits compared with 11 million bits, and the answer to the question therefore is less than 1% of the information that hits our senses as being consciously processed. Now, I have seen other research that suggests it might be around 5%, which is still a very low proportion as well, but perhaps if you gave the answer B, then you might want to give yourself half a point there as well. So that's all very interesting. What we're going to talk about in this session really is how some of the insights from the way we process information and what attracts our attention can impact our investment decision making. Now, for a quick little fun exercise on attention generally, you can check out a video called The Monkey Business Illusion, which is available on YouTube. It involves people throwing basketballs between each other. You have to count up the number of passes, and it's got a little surprise inherent in the exercise, which just sort of highlights how our attention can be distracted when we're particularly, in that case, consciously processing information. Now, if you think you've seen it before, it's still worth a look because it's a little bit different and does contain one or two surprises for people who've seen something similar in the past. So you might want to have a pause now and have a look at that. If not, we'll continue on. Okay, so welcome back. And picking up from the video, we're going to look at what the psychology evidence can tell us about the information processing more generally and how that leads to investment decision making, errors and things being overlooked. So if you look at the psychology of attention and information processing, it tells us a few things. And it tells us what types of information tends to most attract our attention, most likely, and is most likely to therefore be processed. And it's information that has various characteristics, such as is in a narrative or a story form. It tends to be about things that are more recent, about things that are changing. It tends to be things with emotional content. It tends to be things that tend to be more concrete, for example, rather than the opposite of those things, which are more abstract concepts, more long-term, things that aren't changing, things that don't have an easily described sort of story or narrative to them. So if you look at an example, and you go and look at late 2016, when we had the surprising election result, which was Donald Trump in the US being elected president, and you look at these characteristics, you say, well, what sort of things were attracting our attention? And the things that attract their attention tended to be things like the sexual assaults, for example, that emerged during the election campaign. Very readily, easily processed and attracting a lot of attention. whereas the types of things that didn't attract our attention were the things that were more abstract, such as the statistical reliability of the sampling methods in the polling results. It was the sensitivity of election results to small samples, or sorry, to small colleges in the small states, which ultimately were very important for determining election results. It would have been information about the reliability of historical forecasting attempts at US elections, which historically have been pretty poor, pretty hit or miss. So that sort of information didn't attract our attention. Had it attracted our attention more so, we might still not have predicted Donald Trump victory, but we might not have been quite so confident in the view that Clinton would win that election, as an example. All right, so if we transition now to investment decision making and say, how is this relevant for investments, we can think, what sort of things might be important that might be being overlooked, because they tend to have those sort of characteristics that we don't tend to focus on. So I'm thinking about things that are a bit more mundane, prosaic, boring, abstract, for example, and not making the front page, but not necessarily things that aren't important. These could be important, but just not attracting our attention. So to give you one sort of category, and I'll give you 4 components to this category, but one category I think sort of fits the bill is information about investment structures. Investment structures aren't particularly exciting, so bear with me, I'm just going to talk a little bit about them, but they are important. So let me give you 4 things here that relate to investment structures that can significantly impact particularly the after-tax returns that investors achieve across a range of circumstances. And here I'm thinking more about people who are investing in Australian equities, but some of the same sorts of things would apply across other asset classes as well to some extent. Now bear in mind what I'm about to say is going to, these are all benefits of owning shares directly, having an ownership structure that gives you beneficial ownership or direct legal ownership over the underlying securities. Whether or not that's involved a professional management overlay or not, I'm not suggesting one way or the other is the best course of action, and neither am I saying that one structure is better than the other across all circumstances, but certainly these are some aspects that might be worth considering for some direct equity investors. Right, so what are the 4 things? Well, the first thing is that if you own shares, direct Australian shares, if you own them directly, if you have a direct beneficial ownership interest in the underlying securities instead of an interest in like a unit trust, which is more like the sort of structure you might see in an exchange-traded fund, an ETF, or a traditional managed fund product. If you have a direct beneficial ownership, then you can avoid the capital gains tax liabilities that can be inherent in some of those unit trust structures. So what does that mean? It means that when you invest in a unit trust or an ETF, there may be capital gains that already have been earned in those trusts. These are gains that have perhaps been the result of share price appreciations that occurred before you bought units in those trusts. And then after you buy the units, those shares might be then sold and the capital gains are realised associated with those shares. So what that means is even though you haven't benefited from the gains, you might find yourself with a capital gains tax liability in those cases. So that's one. A second aspect around direct share ownership is the opportunity to have what's called tax lot optimisation. And this is the idea that you or your financial tax advisor can potentially allocate for tax purposes a parcel of shares that you're sort of deemed for tax purpose to sell. So when you sell a parcel of shares, for tax purposes you can nominate which parcel, at which cost price you've been deemed to have sold. And obviously that can be beneficial depending on your tax circumstances to either maximise or minimise the amount of capital gains tax or capital gain that you're realising at that time. And of course in a unit trust structure, because you're commingling yourself with a whole lot of other investors, you can't optimise those tax arrangements specifically for your tax circumstances, and that one can be important regardless of your tax position, whether or not you're a fully high marginal tax paying investor or whether you might be in pension phase in a superannuation account, because even in the pension phase the capital gains tax can have implications for your beneficiaries ultimately in a deceased estate environment. So that's two. A third one is if you have a professionally managed direct share investment and you decide to switch from one manager to another. Well, if you're doing it while you still have a structure which allows you to have direct beneficial ownership, you can transfer the underlying securities. If one manager owns CBA and another manager owns CBA and you want to transfer from one to another, then you don't need to sell the CBA, you can just transfer the CBA shares from one to another. There's no need to realise any capital gains tax you may have on those CBA shares, for example. Whereas in a unit trust structure, for example, you end up with the need to realise the units in one trust and then purchase the units in other, and whatever capital gains tax is associated with that differential in the purchase price versus the sale price of those units. So again, it can lead to another tax implication. And fourthly, the fourth point here is that by having direct beneficial ownership, you can have the opportunity to take advantage of corporate actions in a way that's specific and relevant to your investment circumstances, your tax circumstances. What I mean here is, for example, share purchase plans or share buybacks, some of which will depend, the benefits of some will depend upon the size of your investment and your tax circumstances, particularly if they've got franking credits attached or that sort of thing. And again, if you have direct beneficial ownership, you can make a decision based on your tax circumstances, whereas the same opportunity isn't afforded to investors who are investing via a commingled or unit trust structure. So hopefully I haven't bored you too much with those four things, but really that's the point, that if these four things are somewhat boring and mundane, that they therefore are more likely to be overlooked in our investment decisions, despite the fact that when you go through and add up what the implications of some of these decisions are and the tax consequences, and then compound them into the future and say what are the long-term implications of the structured decision itself, as I say, a type of decision that tends to often be overlooked or downplayed, it can have significant implications. It's not hard to end up with hundreds of thousands of dollars of difference over a long period of time. Now, as I say, bearing in mind that I'm not intending to give you financial or tax advice here, so please speak to your relevant advisor before you make any investment choices. Second thing to note is that I've really just touched there on a couple of aspects of how attention affects our decision making, but the broader field of the behavioural finance, particularly around attention, is has quite a rich literature around our investment decision making. So if you're interested in more on this topic, I would refer you to my book, which is called Applying Behavioural Finance in Australia. It's available on Amazon and other online retailers. There's links to it on my website for further reading. Now, before I leave you from this video, I'm going to just give you another multiple choice question, the answer to which I'll give you at the start of the next video in this series. But here is the question. Actually, sorry, just step back. The next video is going to be more about surprises and how even if we are paying attention, some of these biases can still lead us to paying too much tax. So the question that I'm going to ask you is about surprises, and here it is. The question is, when someone is 90% sure they know an answer, how often are people actually correct? When they're 90% sure, what proportion of the time are they actually correct? You should see some answers up on the screen before you now, and I'll give you the answer when we return with the next video.